I'm not trying to predict anything. I'm not a financial advisor, but this is based on my experience, and it's simply a principle. It's a principle that the wealthy follow. Disciplined investors, investors that have large portfolios, reallocate from frothy markets and into discounted markets when frothy markets are frothy and discounted markets are discounted. They don't wait for the media to start talking about everything and then decide to move. And that is what is so hard for the everyday American to grasp. They find it very difficult to move into those discounted markets because they don't know how to, one, find them. They don't know how to find those discounted deals. They don't know how to manage those discounted deals. They don't know how to operate those discounted deals. And really, for that matter, they're disconnected from them. They don't have the information to underwrite them. And so, the best thing that you can do is partner with an operator who that's what they focus on. And the time is you've got to jump in when the pendulum is at the very bottom or it's hitting towards the bottom so that you can be involved during that opportunity when the market climbs back up. And so that's where we're sitting at today with real estate. We see a very, very, very soft market. And it's a market that is not nearly at all similar to the '07, '08, '09 subprime crisis. At that point, it was valuation, property valuation, and distressed properties. You saw in Florida, banks were dumping properties that were just destroyed, and flippers stepping in and had huge opportunities to step in and value add. We're not seeing that right now. We're seeing undercapitalization. And with undercapitalization, we've got upside down loans on good assets, or we've got loans that are right sized and they're properly sized loans, but operators that don't have the capital to manage the assets. And so it creates a unique opportunity that is going to be a very, very short window. And the window is not going to be open and available once the equity market corrects. Because when the equity market corrects, at that point, everyone is going to be moving their money out of the market, out of the equity market, and trying to get into real estate. And those people are going to be the ones that cause the real estate market to go back up. I'm waiting on that to happen. Right now is the time for smart money, and smart money is already moving into. We saw the BlackRocks, the KKRs shut off redemptions and distributions 3 years ago, similar to what we did. And now they're opening back up their allocations back into real estate right now. And there's a reason. There is very, very, very smart individuals that run those real estate arms of those private companies. And they know that right now is the time to start jumping into real estate. And if you wait until the equities market corrects, then you're going to be selling at a discount and buying at a premium when you need to be focused on the opposite, selling at a premium, buying at a discount. And that's what smart money does. Walk us through that diversification a little bit, Brian.
Yeah, I think you really see two big buckets out there right now. We've talked about all the dry powder sitting on the sidelines. And to your point, you've got some smart people for some of these large companies. And one of the largest has tens of billions, I think close to 80 billion sitting on the sidelines. That's been on the sidelines for a while. Interest rates obviously have not made it optimal to start bringing some of that capital. So it's been a credit market, right? We are slowly starting to see that capital work its way into the market. And it's kind of like front running. Do you want to be ahead of that capital that's making its way into the market, or do you want to be behind that capital that's making its way into the market? So that's a bucket of money that's starting to make its way into the real estate market. The second bucket is money that's sitting in the equity markets that's looking for rebalancing or rediversification. There are literally trillions of dollars. So smart money is looking to reduce some risk and take some of those gains off the table and reallocate that into an asset class that, number one, can reduce volatility. Number two, take advantage of forced appreciation, which we're seeing in the marketplace right now with some really, really good deals. Obviously, get tax advantages and generate cash flow. And so I think if you look at the smart money that's out there, both from the public equity markets and all of the private equity dry capital that's on the sidelines, the big question for us is, do you want to be in front of that or do you want to be behind that? And so from a diversification standpoint, it makes sense for you to join that group if you have money in public equities markets. And again, we're not saying to sell everything, right? No one would ever encourage you to do that. But look at some of those gains that you may have. And does it make sense for you to take advantage of a portion of your total portfolio and invest it into an asset class where you essentially can sell high and buy low, which is what every expert would encourage an investor to take advantage of?